All right. Hey, what's going on, guys? Hope everyone's having a great weekend. Hope everyone's having a fantastic holiday. I know it's Easter. Hope you're spending time with friends, family, people you care about, or even just yourself. Hope you're enjoying yourself during this delightful time. What a past crazy few weeks it's been, right? I haven't done a video in about 3 weeks. I've been very busy lately. I went to Coachella Music Festival. I was working there, and it was like kind of like half vacation, half work, so that was super fun. And went on a few camping trips with some buddies, and it's been a great time to just kind of enjoy life during this market turmoil. I haven't really been trading too much lately. This video, I want to go over why I think the market can potentially see more downside, and it's only due to one technical reason. I want to keep it very short, simple, and concise. I'm a huge technical trader. Some of you may know, some of you closer to me, or some of you who've been working with me. You guys know I love my charts, and I love how it tells the full story of the market and the market's perception of things. So basically, this is /ES. This is the ticker symbol. It's the E-mini S&P 500 index futures. And we all know how SPY likes to fill gaps. So in some of the previous videos that we went over, or that I've made, we've gone over how SPY likes to fill all these different gaps. Remember I was looking at some gaps, kind of up here in this area, and we were looking at, previous gap fills and things like that. Essentially, all I'm trying to focus on is on this ticker symbol, ES, which is the E-mini S&P 500 index futures. We have this gap down here on all time frames, our daily chart and our weekly chart, where each candlestick represents 1 day. For all my newcomers or anyone not so familiar, this is a daily chart. Each candlestick represents 1 day. And what do I mean by gap? So back in 2023, December 8th and December 9th, December 11th, the market made a gap at 4613.75. To my best knowledge, what I remember this gap fill was made when the market presented good news revolving around AI, I'm pretty sure, and potentially around Federal Reserve lowering the interest rates. That was what I think was the good sentiment at that time. We made a gap here on that day, and it's never been filled. And the funny thing is, if you look on this chart and you look at any other previous gaps, let's look at this one right here, right? This one right here, it got filled. Okay, so that gap got filled. So that's one gap that's gotten filled. Look at this one right here. This gap right here. Has this one gotten filled? Oops. Right around 56, 57. Let's draw a price level there. Move my head all the way right there. Let's draw a price level right there. At 5641.5, we had a gap. Has it gotten filled before? It has. Okay, you can see right here. From there to there, it has gotten filled. A gap fill just means that the price is eventually going to come back and fill that area. The price action comes back and fills that area that was once empty. The gap fill is absent of support or resistance, and it's usually a magnet for traders to kind of come closer to that gap so that they can fill the gap. And the gap can be made on a variety of different reasons. It's usually news-based for the most part. All a gap is when the market ends up trading at a higher price during pre-market or after hours, and it opens up at a higher price the next day than before, where it closed at the day before. Pretty simple concepts for the most part, but we look at, those are the only two gaps I see on ES right there. 3 gaps, 2 of them have gotten filled, right? This one has gotten filled and this one has gotten filled. And I just think to myself, like, this one, there's a good chance that this one can get filled too, especially since we're closer to it now and we've seen such a huge market downturn. I'll bring in the fundamentals of why this could happen in just a minute as well also. But even if I zoom out to the weekly chart, where each candlestick represents 1 week, we can see this gap is very, very obvious right here. It's just sitting pretty down there. Whoops. It's sitting pretty down here. Okay, and it's just waiting. It's like a magnet. It's like a magnet zone, and I just think the market has a really, really great chance of seeing that price sometime in the future. Now, the market doesn't need to do that. As I've said around other gaps before, I've always said the market does not need to fill any gaps for us. The market does not need to do this for us or anything like that. I just think that there's a really good chance that it can come down. So if the market does end up moving further down, it's good to stay prepared for that, okay? I understand that could be wrong. This is not advice. It's not saying me. It's saying, hey, the market's going to crash, everybody. It's just me just preparing. That's all I've been doing this entire year. I'm up 18% this year. I lost around 2% during the market downturn. I was playing defense for the most part. When Trump announced his tariffs, that was completely just unexpected to me. I just managed my risk. I think I've been doing a pretty good job at that so far. And I just look to prepare myself for what's eventually to come next. And honestly, I see this as opportunity even too, right? As an option trader, we can trade the downside. So even just seeing this gap right here, it gives me a thesis saying, hey, I think that the price can sometime maybe reach this area down here at some point in the future. And no, I'm not trading futures. I'm just using this as a gauge to understand the S&P 500 better. So I do think that the S&P can see this gap area down here sometime in the future, 4613.175. If I look on this weekly chart and I try to find any other gaps, I'll notice that there really aren't any other gaps. And if there are, they've likely gotten filled. Looks like there might be a small one right here during COVID, maybe perhaps, but it hasn't gotten filled. I'm trying to find any more over the past few years, and I just don't see any. It just makes me think like that one gap there. Is that one gap going to be going to be the exception? Is that going to be the exception gap where we just never fill it and the market just wants to keep churning upwards? Sure, maybe. But at the same time, I think the market's there's a really great chance that it will come down to this price. Looking at the fundamentals, right? I know a lot of us have been, paying attention to what Trump's been saying, and a lot of it has been, it's been some mix of politics in the economy lately in the markets, which just hasn't been the prettiest sight to see. Look, things can happen quick. We might get more bad news. I know China is retaliating right now in their tariffs. That's a big one, guys. That's huge. Like, if China keeps retaliating and these tariffs are here to stay, like I think it's above 200% right now, that's going to take a huge chunk out of out of GDP of the U.S. economy, and it's going to raise prices. Very, very likely, it's going to raise the price of goods, which contribute to inflation, and it's going to raise the cost of goods for businesses as well. And how are they going to try to get around those higher prices? Well, they have to cut costs somehow, right? They either have to cut costs in their products or they have to cut costs in their labor, right? They have to do something. If they go the labor route, they're going to start laying off workers. That's going to be bad for the economy. That's a recession signal. Inflation's also not good. Stagflation is, again, a word just kind of up in the air right now, right? The Federal Reserve, if inflation increases, right, they have to keep interest rates maybe steady. But if the labor market starts to weaken, they have to stimulate the economy a little bit somehow. They might lower interest rates potentially as well. And that just kind of creates that dilemma. It's like, do we have a weaker jobs market or do we have higher inflation? Which one comes first? Which one is more important? Which one do they prioritize? It's a kind of a tough crossroad for the Federal Reserve as well. And they're here to navigate that and here to do the best that they possibly can. But if the hard data start coming in and inflation does in fact rise and jobs do weaken, then yeah, that's just a tough sign for equities, and it's not going to be the prettiest sight. So that's my market spill. I am bearish. One last thing as well. This is on ES and this is also on the S&P 500. Is we have our death cross, guys. It happened. Okay. We have our death cross, and this death cross has resulted in the following of bear markets and a lot of, great market corrections. Sometimes death cross doesn't always work. There's been exceptions in the past, but it's here. It's where the 50 moving average crosses with the 200 moving average. That's what the death cross is. And the moving averages are now they're sloping downwards, and they're now starting to they're going down. That's the direction they're going in. They're moving downwards, right? Beforehand, the past 2 years, we've seen these moving averages. You can see on my screen, we've seen these move upwards, right? And we had our golden cross right here back in 2023, where the 50 moving average crossed the 200 moving average with an upward slope. Ever since then, the market's been on a bull run. And now we're finally greeted with our death cross. And when was the last time, guys, we had our death cross? When was the last time? Right? Let's take a look. 2022. Beginning of 2022 is when we had our next death cross right here. Okay? That's not to say the market can't go up in the short term. Right here it did. But overall, the overall trend was starting to become bearish. We were bearish for around 2.5 years. The same thing's happening again. right? The market just repeats itself. It's ebbs and flows, right? Every single moment is unique in the market. Human nature often doesn't repeat itself 100% accurately, but it often rhymes. And now we're just seeing another version of what has happened before. A lot of people are comparing this to the dot-com bubble. A lot of people are comparing this to the financial crisis. You know, it's very tariff related. It's a supply chain shock. And some can also say some irrational exuberance is falling now. AI is not strong enough to carry what's happening here right now. The main catalyst has been tariff news and supply chain shocks for the U.S. economy. And the U.S. economy is they're driving down, they're deglobalizing everything, man. They're putting tariffs here, Some countries have reached out, some countries have negotiated. They're like, hey, we don't want these tariffs. But guys, tariffs just aren't good for the economy no matter what. They might help a select few, you know, it helps us a select few, but it sacrifices the majority. And, you know, sure, maybe there's other reasons that tariffs can potentially be good, but I'm sure they're probably not economical. And from an economy standpoint, from a trader standpoint, from an investing standpoint, our job here is to make money from the markets. And we absolutely still can do that, but we need to adapt and we need to understand what kind of sentiment this is driving. And so far, it's been a bearish sentiment. And going back to that gap, I do think that we might be able to fill that gap in the near future and maybe take another leg down. Okay. So this is where we're currently trading at. And this is where I potentially think we could see in the future somewhere down here. All right. So thanks for listening to my market spill. I hope everyone's been doing well. I hope everyone's been taking care of themselves and navigating this market environment with good risk management. And if you're just getting started too, I really hope you've been learning from this environment. I want to let you know right now, I started trading in 2022 during this bear market right here, options. When I started trading the downside, I started learning how to short stocks. Guys, learn how to short stocks if you have that opportunity to. I mean, if you're just an equity trader, you're interested in investor, you don't really care about that, that's totally fine. But if you're an options trader, you've been doing this for some time, there's opportunities to make money, buying and selling volatility. It's good to really know this stuff, and it's a great market environment to practice in. Volatility creates opportunities. We shouldn't shy away from it all the time. Yes, if we don't know what the hell is going on and the market takes us by surprise, we need to play defense. And that defense means just not taking any positions, staying cash, or just simply just relaxing. But overall, like, if you ever have the opportunity to trade a market condition like this, and you know how to make money from a market condition like this, you guys are going to be recession proof. Who doesn't want to be recession proof, right? No matter what happens in the market economy, you know how to make money. You know what kind of opportunity exists, right? I'm sure some traders have been doing very well in this market environment as also. It's been very challenging, but I'm sure some people have been doing very, very well. So I encourage you to learn, have a winning mindset, to continue to move through this gallantly, with poise, with respect and honor to the markets, and adapt like a warrior, like a fish, and really understand the market's harmony and go from there. So thank you for watching. I really hope you appreciated this video. I really appreciate you watching, and I will talk soon. And if we have any more one-on-one sessions together, I will look forward to meeting with you very, very soon. So thanks for watching.